The stock market has been on a very impressive tear for the last 2 years. But let's face it, every investor knows the market has to eventually swing. We're going to have cycles. And even though history doesn't repeat itself, it rhymes. We've seen devastating crashes wipe out trillions of dollars in today's money, from the Great Depression, the dot-com crash, the financial crisis, and the COVID crash. The warning signs are always there in hindsight. But when will the next crash hit? And how bad will it be? In this video, we're diving into the key indicators that may signal that a market crash is coming. But you can position yourself to take advantage and be ready emotionally and with money when it does happen. For those of you who don't know, a pullback and a full stock market crash are not the same thing, but they are closely related. A pullback typically refers to stocks falling between 5 and 10% quickly, and then rebounding shortly thereafter. Think of short-term market sentiment shifts from the news, earnings, controversy, acquisition, hypesters, all these random things that happen. You get the idea about what I'm saying there. A stock market crash is much more intense and usually takes significantly longer to recover from. Now, there's no standard amount that a stock must fall to qualify as a crash. For example, in the 2000 tech bubble, there were 3 years in a row of the S&P going down. The NASDAQ fell 83%, but it took 3 years for that to happen. Yes, there were a lot of big drops and very quickly. You look at the great financial crisis. Things started to drop in September, went back of 08, then went back up, then came back down, crashed. It was a drawn out period. Then you look at COVID. It was a 40% drop in 4 weeks. Now, since 1950, the average decline has been about 32.7% and lasted over 2 years. Now, depending on your age, you probably looked at these all-time highs and felt pretty rosy and felt pretty good about these because you've yet to experience a really bad bear market or a crash. I want you to go to your brokerage account and look at the amount you have invested. Now, imagine seeing that number drop by 40% or 50% or 60% in the next 2 years. Would you be able to handle that? 20 years ago, seeing stocks fall got me scared. I would say, is this going forever? Is this going to keep going down to zero? Am I going to lose everything? But now, after learning about history, understanding what caused these things, and more importantly, understanding valuations and how to value the market and businesses, it makes me feel much more confident to embrace a crash. Yes, it still hurts the pocketbook and the ego to see my account fall. But if you have the proper training, the proper people around you, you can see that it's absolutely imperative to your returns on the long run that you don't do the things that you naturally feel inclined to do, the things that I felt 20 years ago. And I'm going to explain why in just a minute. The thing that shifted my thinking 20 years ago was starting to understand the stages of a bubble. That's extremely important to understanding what can possibly happen. As frequent as market corrections are, this does not stop investors from panicking and making emotional decisions with their money. No one is immune from that. Everybody in history has done that, including Warren Buffett. And if you look back at history, this should not be surprising. Why do so many lose sight of this? This time it's different. Guys, I've heard this countless times. And the funny part is, it's often talked about as the four most dangerous words in investing. It's not different. How many times has it ever been different? Never. At the end of the day, every investment's the present value of all future cash flows. And a 10% return is a 10% return. If you're just starting out, you've already seen some bubbles burst a little bit. Electric vehicles, cannabis, NFTs. I currently believe that we're in a crypto bubble and an AI bubble. And guys, bubbles are nothing new. The first recorded bubble was that tulip mania crisis back in 1636. That was the time when people were betting on tulips being worth a lot more money. They had no intrinsic value. They were just worth a lot more money. Was it different for any of those bubbles? It sure felt like it as it was going up. This is different. Every single time it's different. I laugh whenever I hear people now saying, Paul, the dot-com bubble, that's totally different than today. This is AI. 3 years ago, this is electric vehicles. This is changing the world bigger than the internet. And I always go, excuse me, bigger than the internet? I consider the internet one of the top 3 or 4 biggest inventions of all time. Regardless, I'm positive it'll continue to be repeated time and time again. You know why? Because humans don't change. The way we are intrinsically will not change. And it doesn't take much research or analysis to notice a pattern. Now I want to walk you through the 5 stages of a bubble. As Warren Buffett says, every bubble starts on a sound premise. Something new or revolutionary will hit the market and begin to grab attention. Or something as simple as, it's wise to go to college. It's wise to own a home. Those are very true things, but they lead to bubble behavior later. There's an influx of buyers and media coverage that builds hype and instills FOMO, that fear of missing out. It starts small, it starts to grow, people start to notice it, then all of a sudden your friends are doing it. News follows the stock price. So what happens next? Naturally, that price starts to climb higher and higher, bringing even more investors to keep adding to their positions. And they buy in and they sell as it goes up. They see it go up higher and higher. It doesn't take long before every other article praises the most recent high-flying stock or investment, and the prices seem as though they could grow endlessly. Unfortunately, guys, that's not how investing works. Otherwise, everybody in the world would be a billionaire or even higher, a trillionaire. After a massive run-up, wise investors start to exit with their profits, shrinking the share price temporarily. But they say, you know what? It's getting a little nosebleed. I'm going to move on. This is what happens that causes something, a joke currency, made up by a guy about his dog, like Dogecoin, goes up 12,000%, and then it's right back down to irrelevance. You can choose any bubble in history and identify each of these 5 steps. Now, you might be thinking, Paul, how will I know when a bubble is about to burst? What signs are there that stocks could fall? The honest truth is we don't know when the bubble will burst. The main indicator of potential bubble burst involves the sentiment in the market, but sentiment can shift very quickly to the positive and the negative. Be wary of any stock that experiences massive gains or sudden spikes in a short period of time without a similar change in fundamentals. And by the way, when I say short period of time, I don't necessarily just mean weeks. It could just be a few years. In the investing world, a few years is a short period of time. Everyone thinks that they take long-term versus short-term based on what the IRS claims that to be. That's not the case. Hype is an early indicator that investors are flocking to an asset for reasons beyond fundamental analysis, and that can cause intense volatility. Now, I'm not saying you should avoid everything that's doing well. Just make sure that the performance is justified based on the fundamentals. And those fundamentals are revenue growth, profit growth, free cash flow growth, a good balance sheet, and all those things coupled together. Always do your own research before starting a position in anything. Don't just follow what somebody on the internet says, or even what Warren Buffett says. He's going to make his own research and his own decisions based on his situation. The questions you need to ask yourself is, do I understand this asset? If it's a stock, do I understand the business? How do they make money? How would they lose money? What's their position in the market? What's their intrinsic value? These are all things that we use our tools and our community and software to go help determine. NVIDIA, for example, is a phenomenal example. It's at all-time highs. In the last year, the company's stock is up 2,700%. And at least for right now, it's showing no signs of stopping. Is NVIDIA a hype stock? Well, it is hyped, but it doesn't necessarily mean it's a bubble. And that's something I've been wrong on. Their revenue, profit, gross margin, returns on capital are incredible, and they're getting better with no signs of slowing. Look at a company like GameStop. This company was up over 5,000% between 2020 and 2021, but there was nothing to justify that. The fundamentals of the business were terrible. The business was getting worse every single quarter. So when that hype dried up, where did the investors go? They left it. What happened to the price? But with NVIDIA, even though we see a big jump in fundamentals, several fold, the question is, does it justify 2,700% growth in the stock price? Well, it could if the future looks just as bright as the last 2 or 3 years. Remember, just because something is up a lot doesn't mean it's overpriced. And just because something is down a lot doesn't mean it's undervalued. It's about marrying fundamentals with price together. But the fundamentals are also driven by the future potential. You're not paying for the past, you're paying for that future. That's what makes investing hard, because we don't know the future. And we're humans, we make mistakes. The biggest thing I like doing is I like to take note of who is talking about this investment. We know that euphoria is a big part of the bubble cycle. And when bearish analysts turn rosy as the price takes off, it could be evidence that outlooks are moving toward mania. But more importantly, what are everyday people doing? Peter Lynch has a great story where he talks about his cocktail party theory. He says, when I go to a cocktail party, if people ask me what I do and I say I buy stocks, if they feel bad for me, I know it's probably time to buy. If they start giving me advice, it's probably time to sell. And if they're indifferent, the market's probably fairly valued. I love that because I love hearing what other people are saying. Now, if the stock is getting beat up or ignored, only to suddenly be plastered all over the TV, investing websites, or YouTube with completely different valuations, at the very least, it's time to ask more questions and dig deeper. We saw this exactly happen through the electric vehicle bubble. For a long time, Tesla stood out as an innovative leader with strong promises. As Tesla became more successful, though, other EV companies started spawning like crazy. It took no time at all for analysts, enthusiasts, and experts to come to the forefront in support of the EV market. But it usually happens on the tailwind of the regular person finding these companies and hyping them up. Now, how many of those companies went to zero? Guys, the vast majority did. And not only that, but how many people are talking about EV today the same way we talked about it just a few years ago? And you watch our past videos, early 2021, I would love for you to go see the comments on when we talked about EV and these workhorse and all these companies are going, Nikola are going to zero. We didn't say zero, but we said these aren't justifiable. The comments we got, you don't get it. EV is the future. EV is everything right now. It's not like the internet. Great. Now you hear nothing about EV. Absolutely nothing. And remember, the market's rot from the outside in. Now here's a shocker for you. It's AI now, right? AI will end up with the same result as EV. There'll be a few players who really dominate and do well, and there'll be a lot of players who probably lose a lot of stock market value. There'll be a massive boom, which we're in the middle of right now. And then at some point, when the returns start to suck, not many will care as much, and we'll be on to the next hype category, because there's always going to be a hype category. The hype is so intense. The FOMO is so intense that it has to drag in casual, everyday people to get them excited, overconfident, and eager to spread their success to any and everyone. And that success makes people jealous. So they want to jump on the same train. But guys, that's not a process for investing. That's a process for speculation. I can almost guarantee no valuations, no financial metrics, and no research of any kind is ever mentioned there. I was recently at a friend's house in Florida, and they brought other friends over talking. And one of the guys said, "Hey, what's NVIDIA doing right now?" And I looked it up. He said, "Man, this company's amazing. They're saying it's going to double in price again." And I said to him, "Well, you know what they do, right?" And he looked at me and goes, "No, I don't know what they do." I remember thinking to myself, this guy's so excited about a company and he has no idea what they do. And guys, this is not an everyday person. This is a person that's worth well over $100 million. So just be wary when your pizza delivery driver or your waiter or waitress or some random young pimply kid next door tries to talk about some sort of investment. Maybe it's time to be a little cautious. Now that euphoria can keep on going. Look at crypto. Look at AI. It's going to keep on going probably for some time. So you might be asking, well, if crashes are inevitable, how do I protect myself and my returns? Guys, nobody has been able to predict where the stock market will go consistently over short periods of time. You can react to it, and a lot of traders will react to it, but it's still a reactionary process. Again, nobody knows where stock prices are going to go in a short time, how long it'll take, or how long they'll stay there. If you're concerned about returns, this is something every single investor needs to hear. Stocks will fall at some point. That's inevitable. Guys, I'm not trying to put fear, uncertainty, and doubt. I'm not trying to be a fudster here. Where we are in valuations and where we've been in this bull market, we have to take a breather at some point. I always hear the adage of like bull markets don't end because of age. Yeah, actually they kind of do. The longer it goes on for, the more complacent people get. And eventually, there aren't enough new buyers to drive up prices higher. And suddenly it might shift. Look at 2000. There was no event that sparked the crash of 2000. It just finally stopped. But I can assure you, the worst thing you can do is sell everything when the market's falling. You might say, "Oh, Paul, I wouldn't panic. I'd ride the wave down and invest more. That's so obvious." Guys, I've been doing this for a long time, and I've seen multiple crashes. And the one thing I've seen happen over and over again is the people who say that are the first ones to sell. And the reason being is there's always a story about why it's different this time on the way down too. Not just on the way up, on the way down. The great financial crisis. Guys, all these value investors bailed. Guy Spear wrote a great book called The Education of a Value Investor. And one of the best chapters where he talks about all these value investing friends he had where the stocks were down 50% and they were bailing. And he's like, "Wait a second, I thought we were value investors." "Yeah, but you don't get it. The financial system's shutting down. The world's going to shut down." Same with COVID. But if you go look at that chart, 2009, where's the one area you wish you were buying? The very bottom. Now, this doesn't mean buying more junk companies that have no fundamentals to them. But it does mean looking at companies that have fallen a lot, but the fundamentals are the same or getting better or not down as much as they should be. That's where you can make a lot of money. Or more importantly, buying the stock market. Because guess what? You have two choices when the market falls. You either buy more or you sell because the world's going to zero. Guys, if the world's going to zero, you might as well buy more because your money's not going to matter anyhow. So you might as well load up while the stock market's falling. Again, all the people I hear say, "I could withstand a 40, 50% fall. I'd buy more." It never happens that way, but it can. And the benefit you have versus past times is you have YouTube. You have this channel. You have people who actually cheer, like people in our community, who cheer when stocks are down. There are pictures of me during the COVID crash taking a picture of my computer screen. In the great financial crisis, the guys from Bank of America Merrill Lynch would call me and say I'm the only good phone call they get because I'd be the one so excited. I have the emails to show it. This is not just words. I see all these financial manslaughter idiots on YouTube, and I always say a lot of them are going to change from stocks at some point. When these stocks fall a ton and they can't explain why or can't explain why they're not buying, they're going to go find something else to go do. This is a tale as old as time. Now, I used to be like everybody else. I remember once during the 2000 crash, literally laying in my bed going, this is going to zero. And it took a few years, but I've completely changed my view on downturns and crashes. Every time the economy has a downturn, we've emerged healthier, wealthier, and better for it every single time. I know seeing stocks plummet and navigating the noise seems like an investor's worst nightmare. But remember, every past decline looks like an opportunity. Every future one looks like a risk. Just change that last word. Every future one needs to look like an opportunity. We have done countless videos in the past proving that those who stuck to their investments saw huge returns in the long run if they could stomach the pain. Even as simple as dollar cost averaging into ETFs. Remember, it's just math. The more you pay, the less return you're going to get. The less you pay, the more return you're going to get. And there's no better time to buy stocks as a whole as when they're discounted. But remember what Warren Buffett says, be fearful when others are greedy, greedy when others are fearful. Remember, it's impossible for everybody to outperform the market. The whole point of the market is the average. And the best way to protect your returns, it's a dollar cost average and a low cost ETFs. We talk about this a ton in our community, in the channel. If you're dollar cost averaging and buying regularly, even when prices are falling, you'll be much stronger position and you'll outperform the market from that time frame. What matters more is time in the market, not timing the market. Pulling money in and out of your stocks is horrific for your returns, and there have been countless studies that have proven that. If picking individual stocks are too risky, I don't blame you. Stick to ETFs. But remember, the example I always give, QQQ is the NASDAQ 100 ETF. At the peak of the dot-com bubble, if you'd bought right then and started dollar cost averaging from there, so you start at the very peak, you would have stomached an 83% fall. And since then, you would have made 13.5% return on your money. The S&P, if you did the same thing at that point, you'd have made 10.5%. But since then, the S&P's only made 6.5 or 7% with dividends, and the QQQ is at about 8.5, 9%. So you would outperform those indexes. That's how important dollar cost averaging is. Over the last 100 years, the average stock market return is somewhere between 9 and 10% with dividends. Obviously, some years are more, some years are less. But if you keep buying robotically, maybe even increasing when prices are lower and below value, you will do phenomenal. Remember, guys, the best way to build wealth over time isn't by betting on a single asset or trend as it's getting exciting. It's about being smart, staying grounded, investing in the long term, and also being diversified. There are only a few investors out there who can stomach not being diversified and kill it. Let them do that. I like being diversified, but it's all about keeping your head cool. It's not about the IQ you need. It's about the stomach you need. If you're able to do that, you're going to do very well. Now remember, I want to shift your focus from fearing stock market corrections and crashes and worrying about how to protect yourself to being excited about the opportunity to buy stocks at cheaper prices. You need to take an offensive mindset when it comes to investing. No one in this world is coming to save you. The government won't bail you specifically out like they did banks in 2007. You need to surround yourself with people who are headed in the direction that you want to go. And you have to keep investing. So guys, if you want to be around like-minded people, join our community. You shouldn't do this alone. When stocks fall, those overhyped stocks will fall the hardest. And most people will panic sell. In our community, when stocks fall, there's cheering, there's excitement, better deals on great companies. This company's out of favor. What's it looking like? What's the free cash flow? What are your assumptions? I love people sharing their stock analyzer tool. There are conversations going like crazy. And right now, guys, at everythingmoney.com, we have a 7-day trial for a limited time for $1 per day. So make sure you take advantage of it while it's still here. Click on the link in the description, get access to everything we have to offer, and take advantage of the community that's going to help guide you and help be there for you and with you when stocks do fall. It'll be the best investing decision you've made all year. Trust me, guys, the emotional part of investing is really, really difficult. I mentioned this earlier that it took me a few years and a major bear market crash to build up a tolerance to seeing and enjoying these massive swinging stocks. But guess what? You can do the same. Remember, market-wide crashes are not permanent. Go look at history. We've had them since the beginning of time in some sort of market in some sort of way, and they always go away and end, and we get to better times. Remember, if they do become permanent, we have much bigger issues than what the size of your 401k and brokerage accounts are. Just know that at some point, we will see more market downturns. Don't be afraid. Be prepared. The key is to stick with your plan, be consistent, and stay focused on the long term. Now, it obviously won't be easy at all times, but look at it as a great buying opportunity that could reward you in the long run if you weather that storm. And if you're in the community, we'll be here to remind you that it's not all bad news. You don't have to endure this alone. No one can predict the future, but what we can do is teach a process that helps you make smarter decisions over the long run. That's what we're all about here, helping you become a better investor. Thank you for your time.